Hi there, welcome to Grain TV. I'm Kevin McNew. It's Monday, March 14th. We had a mixed day in grains. Let's take a look at the Grain Hedge trading platform and see where we closed. In Chicago, corn and wheat were leaders to the upside, gaining 3 3/4 cents and 3 1/4 cents respectively, while beans finished the day unchanged, unable to break through $9 a bushel. News out today was pretty light, but let's turn back to last Friday after the close when the CFTC came out with their latest commitment of traders report. And in that report, what we saw was a record large position by funds going short in corn, almost 250,000 contracts. That has set the stage for more intensity on this short covering rally. Many people had expected that number to be lighter than it was because they thought funds were liquidating last week, but turns out they were actually adding to their position. So overall, we came out Sunday with a stronger open and spent most of the day in significantly higher territory, but still facing some selling pressure as a result of the burdensome stockpile situation, not only in the U.S. but abroad. Other news out over the weekend, the rains in the plains were pretty limited. There was some rains on the eastern side of Kansas and Oklahoma, but overall the real heart of the hard red winter wheat country saw no rains over the weekend, and the outlook for the next week is pretty dismal for any sort of material rains that will improve the soil condition. There also is an outlook for a freeze next weekend in that Kansas, Oklahoma region, so people will be watching that. Temperatures are expected to fall around 28 degrees or less, potentially having a hard freeze impact on that somewhat vulnerable hard red winter wheat crop. In outside markets, crude oil took it on the chin today, giving up $1 a barrel after Iran said over the weekend that they would not be limiting their production, that they are all ready to gear up after getting their trade restrictions lifted, and they will be gearing up to produce 4 million barrels a day, and until they reach that point they have no interest in participating in any sort of reductions in output. So that's in crude markets down pretty sharply after last week's big rally. Let's turn now to some of the export news that came out today. In weekly export inspections, USDA showed all three commodities well within line of what analysts were expecting. Corn export inspections were 104,000 metric tons versus trade estimates of 750 to 900. Soybeans also falling in expectations that range from 650 to 1 million metric tons, with 715,000 for the week, and wheat coming in at 406,000 versus expectations of 300 to 450. Now, when we look at the year-to-date scorecard, how we're doing versus last year, both corn and wheat falling more behind last year than what USDA has factored in right now. Corn at 19.4% of last year's pace versus USDA looking for 11% drop in exports year on year. So, we are improving that gap, but it is still in the red. Beans, on the other hand, are slightly better than last year relative to what USDA has projected. But with the change in the currency situation, Brazil's currency has strengthened, which will leave them vulnerable to seeing some decline in export potential as they come out of harvest. Our dollar has fallen about 4% in the last 2 months, which is favorable for our export situation going forward. But it's going to be a close call whether we finish the year on mark with USDA's export expectations. Let's turn now to what's coming out tomorrow, and that is the NOPA crush numbers for soybeans. Analysts are looking for a range of crush for February to range from 136 to 144. The expected is just below 140 million bushels for the month. That is off from 150 last month and 146 last year. If you remember, last month's NOPA crush numbers really disappointed, coming in well below trade expectations going into that report. So can we see a slightly better number this year or this month than we did last month? That'll be something to look for at 11 a.m. Central Time when NOPA releases those numbers, and likely have some impact on soybean trade. Let's change gears now and talk about the corn chart. We had a strong day today, not overly strong, but we are in a short covering rally, so ranges are fairly limited, but we did see a 3-cent advance today. We pushed above that 50-day moving average in red there, and what we're sort of looking for as the next target is that 373 mark. That's where we probably will face a lot more resistance, and if we can push through there, then we might see some more upside. But I think it's going to be, sort of choppy trade, slow trade, getting up to that level and potentially breaking through it, just because of the large stocks we have, the slow export program we have. There's nothing at this juncture to really spark the shorts to really excessively liquidate their positions, even though they are at record large potential. If you are interested in where the markets are going and looking for some technical guidance, every morning Grain Hedge puts out, or before every trade session I should say, puts out our technical alerts that guide you in where the markets are likely to move based on technical indicators. On Sunday night before the market opened, we were calling for a higher open on grain and about a 2.5-cent advance in the corn market. You can see here on the hourly chart for May corn, this is when we alerted our clients to it based before the market opened, and we actually hit our price target around 367 a few hours into the morning session. So if you're interested in technical alerts, by all means visit us online at grainhedge.com or give us a call 877-472-4607. Grain Hedge is pleased to announce a new tool called Technical Alerts. Technical Alerts is free to our trading clients and delivered by email first thing in the morning every trading day. Technical Alerts is a powerful, easy-to-use system that provides quality trading opportunities. Each trading opportunity shows a chart and analysis, providing clear price targets and risk potential to allow you to make an educated trading decision. The commodities covered include grains, livestock, crude oil, currencies, bonds, and metals. Technical Alerts look at historical chart formations and compare the current environment to the past to form concrete trading recommendations. Let's take a look at how to interpret a technical alert. At the top, you will see a red or green indicator arrow which signifies the market's likely move. Red shows when weaker prices are expected, and green for when higher prices are expected. The summary section shows the expected price target and the expected duration it should take to reach the target. Also, Technical Alerts provides both support and resistance to help you identify key levels on the price chart. Underlying support is where technicians believe there is a level of buying interest, while overhead resistance is the price level thought to trigger more active selling. The support is marked with the letter A on the corresponding price chart, and resistance is marked with the letter B. Below the chart, you will see the data interval of the bars. For example, a 1-hour data interval means the chart pattern was constructed from a 1-hour bar chart. And when you are using the Grain Hedge trading platform, you can use the pull down on your chart to change the bar interval to the appropriate time period. As always, we strive to provide you the best tools to improve your trading and hedging activity. If you have any questions on how to use technical alerts, please contact us at 877-472-4607 or by email at support@grainhedge.com.